Have you ever considered the profound potential held within your first $500 of investable capital? For many, that sum evaporates almost as quickly as it arrives. One moment it represents opportunity, the next is being consumed by a speculative meme coin that plummets overnight. Too many promising investors are derailed at the outset by chasing elusive can't-miss opportunities peddled online. The purpose of our time together today is to correct that course. We will move beyond financial jargon and speculative gambles to construct a durable, intelligent investment plan that is designed to function and grow even while you sleep. Welcome back to the channel. If you are new here, our objective is to demystify complex financial concepts and transform them into clear, actionable strategies. For those who find this approach valuable, consider liking this video. It helps the algorithm connect our content with others who might benefit from this guidance. A complimentary guide summarizing today's key points is available in the description below. The 3 traps that wipe out beginners. Before we build, we must first understand the common pitfalls that ensnare so many novice investors. Let's address them directly. Trap 1. Concentration risk. This is the error of investing your entire sum into a single stock. This is not disciplined investing, it is speculation that leaves you perilously exposed. True investing is built on diversification, a principle that protects you from the inevitable failure of any single company. Trap 2. The futility of market timing. This trap involves waiting for the perfect moment to invest, often a dip in the market. The problem is that predicting market movements is a fool's errand. More often, investors wait, the market drops further, they panic, and they sell at a loss, only to see the market recover without them. Our strategy will favor time in the market over timing the market. Trap 3. The corrosive effect of fees. An annual fee of 2% may sound insignificant, but over the long term it acts as a powerful drag on your returns, quietly eroding your principal and consuming a substantial portion of your potential gains. We will construct a portfolio designed to minimize these costs and maximize your growth. Pick the right account in 5 minutes. Your first strategic decision is selecting the right investment vehicle. Bypass the traditional brick-and-mortar banks that may still charge exorbitant fees like $12 per trade. Instead, open an account with a modern brokerage firm that offers 2 critical features for new investors. First, zero commission trades on ETFs. This ensures that your initial investment isn't immediately diminished by transaction costs. Second, the ability to purchase fractional shares. This feature grants you access to high-priced blue-chip stocks, allowing you to buy a portion of a share rather than needing thousands of dollars to own a single one. Reputable firms like Fidelity, Schwab, and Vanguard are excellent choices. For those who prefer a fully automated approach, robo-advisors such as Betterment or Wealthfront will construct and manage a diversified portfolio for a modest advisory fee, typically around 0.25% annually. Opening one of these accounts is free and often takes less time than ordering a meal. The 1 ETF core. Now let's construct the portfolio. A common misconception is that you need a complex array of funds. In reality, a single broad market exchange traded fund or ETF can serve as a powerful foundation. Our choice for this core holding is VOO, the Vanguard S&P 500 ETF. By purchasing this one fund, you gain ownership in 500 of the largest and most influential companies in the United States, including giants like Apple and Microsoft. This provides instant diversification across the economy. Critically, its expense ratio is a mere 0.03%, which translates to just 3 cents for every $100 you invest. Allocate $300 of your initial $500 here. This is the engine of your portfolio. Sprinkle in dividends for cash flow. With the core established, we will add a second layer, an income generating component. For this, we turn to SCHD, the Schwab US Dividend Equity ETF. This fund specifically screens for companies with a proven history of not only paying dividends but consistently increasing them for at least a decade. Allocating $100 here allows you to acquire fractional shares in these robust businesses. This starts a flow of dividend payments that can be automatically reinvested to purchase more shares, creating a self-fueling mechanism for compounding growth. Think of this as establishing a reliable income stream within your portfolio. Real estate without being a landlord. Our third component introduces diversification into an entirely different asset class, commercial real estate. We achieve this without the immense capital and hassle of direct property ownership through VNQ, the Vanguard Real Estate ETF. This is a real estate investment trust which holds a vast portfolio of properties. You become a fractional owner of data centers, industrial warehouses, and critical cell towers. An allocation of $100 makes you a landlord to some of the most reliable tenants in the world, Fortune 500 companies who consistently pay their rent. This position adds another layer of diversification and an attractive yield, which is currently around 4%. Park the last bit somewhere safe. The final portion of your capital, between $50 and $100, should be set aside not as an investment, but as a crucial element of risk management. Place these funds in a high-yield savings account, which currently offers returns of 4% or more. This is your liquidity buffer or emergency fund. Its purpose is strategic. It prevents you from being forced to sell your long-term investments at an inopportune time to cover an unexpected expense, like a car repair. This buffer protects your compounding machine from short-term life events. Automate the follow-up. The final step is to put the entire system on autopilot. The key to long-term success is consistency, not genius. Establish an automated weekly or bi-weekly transfer from your bank to your brokerage account, a sum that is manageable, perhaps $20 or even $10. Your brokerage can automatically invest these funds across your 3 ETFs according to your target allocations and will reinvest all dividends received. This practice, known as dollar cost averaging, removes emotion and decision fatigue from the process. You must learn to ignore the daily market headlines. You are no longer a trader reacting to noise. You are an accumulator, methodically building ownership over the long term. If this framework has provided you with clarity and a tangible path forward, subscribe to the channel to continue building your financial literacy. Share this video with a friend who is ready to take their first step toward investing. In our next video, we will explore how to analyze and grow the income stream generated by your new portfolio. You won't want to miss it. You began this video with $500 and perhaps some uncertainty. You are leaving with a concrete plan to own a piece of the US economy, a stream of income from dividend-paying corporations, and a liquid safety net to protect your progress. The true power of this strategy is that it operates independently, allowing you to focus your energy on what matters most, increasing your earnings to further fuel your investment engine. This isn't just about investing $500 one time, it's about building a system for a lifetime. When you've made your first investment, comment "I'm in" below. We'll see you in the next one.